Hey everyone, welcome back to Alpha Insights. I'm Adam.
And I'm Niva. Great to have you with us today. And hey, if you have questions while you're listening, drop them at stockalpha.ai.
Today we're digging into market breadth, the stuff that tells you whether a rally is broad-based or just propped up by a few mega winners.
Right. Breadth isn't sexy, but it's one of the best early warning tools out there. It measures participation, how many stocks are actually joining the move.
So the real question here is, why should you care if the index is up, but most stocks are not? Simple. If only a handful of names like Apple or Nvidia are lifting the S&P 500, your diversified portfolio might not be seeing that upside.
Exactly. And data suggests that when participation narrows, corrections tend to follow more often than when breadth is healthy. So we track a few core indicators to get a clearer picture.
Let's start with the advanced decline line, the workhorse. Every day you take the number of advancing stocks minus decliners and add it to a running total. When that line climbs with the index, it's confirmation. When it doesn't, that's a divergence and a red flag. Put simply, index up, A/D line up, healthy. Index up, A/D line flat or down, narrow rally, caution.
And to add to that, you can watch the exchange that matters for your exposure. NASDAQ AD gives a better read on tech-heavy moves. The NYSE AD is more reflective of cyclical and value participation.
Next up, new highs versus new lows. Exchanges publish daily counts of stocks making 52-week highs and lows. Chart the spread, highs minus lows, and you get a sense of momentum across the universe.
When new highs wildly outnumber new lows, momentum is strong. But when that spread narrows or flips negative while the S&P 500 keeps climbing, that's non-confirmation, and it's meaningful.
Yeah, that's a good point.
Another practical one is percent of stocks above moving averages, usually the 50-day and the 200-day. It's a way to translate breadth into a trend-following context.
Rule of thumb, if more than 70% of stocks are above their 50-day, that's strong intermediate participation. Below 30% is weak. For the 200-day, above 70% looks like a broad, long-term bull market.
And if you see the S&P 500 at new highs while only, say, 35% of stocks are above their 50-day, that tells you the advance is narrow.
So how do you act on divergences? First, verify with multiple indicators: A/D line, percent above moving averages, new highs versus new lows. If several of them are flashing, that's when you raise your alert level.
Right. But remember, it's not a switch you flip. Treat divergence as a risk management signal. You might trim concentration in the handful of leaders or size hedges differently. Analysts note this is about lowering risk, not timing exact tops.
Honestly, I was a bit surprised by how often people chase headline highs without checking internals. It's common mistake number one.
Yeah, chasing is real. Common mistakes also include relying on a single breadth indicator or ignoring sector breadth. A healthy market needs participation across cycles, not just tech.
Let's run two quick scenarios to make this concrete. Scenario 1, narrow rally. Imagine the S&P 500 gains 6% over a month, but Apple and Nvidia account for half the index's gains, while 70% of S&P 500 names are flat or down. A D line is flat. Percent above 50-day is 38%. That setup warns of vulnerability when leadership stumbles.
Oof. Not fun if you're stuck in lagging names.
Scenario 2, broad-based bounce. After a 10% pullback, the market recovers 7% in 3 weeks. The A/D line climbs, percent above 50-day goes from 22% to 58%, and new highs outnumber new lows. That breadth thrust suggests the rally has legs and momentum is more reliable. A few practical checklist items for daily workflow. Glance at the AD line trend, percent above the 50-day, and new highs minus new lows. Check sector participation. Are cyclicals joining, or is it all tech? And verify volume trends.
Also remember, time frame matters. Use daily and weekly breadth for tactical calls, monthly for regime decisions. Breadth can give false signals, so corroborate with volume and macro context.
Okay, wrapping up. Key takeaways?
Breadth measures participation, not price direction. Divergences between the index and breadth are reliable early warnings, but they're signals to manage risk, not prompts for precise timing.
And use multiple indicators. A to D line, new highs versus new lows, and percent above moving averages. Check sector breadth and volume. That combo will make your market read much more nuanced.
Got questions? We'd love to hear from you. Head over to stockalpha.ai, where you can ask us anything, and we'll answer live. And while you're there, check out more market content.
Thanks for listening. I'm Adam.
And I'm Niva. See you next time on Alpha Insights.